Right, good morning, everybody, and welcome to South East London Chamber of Commerce in association with Hornblower Business Brokers and Thackeray Williams LLP Solicitors, bringing you today a fantastic and interesting webinar all about whether it's the right time in the current financial climate to sell a business as a going concern, or is it worth holding on for another couple of years to see what the future brings in terms of building that business and adding a bit of value to it. This morning, we're going to be hearing from Henry Campbell-Jones of Hornblower Business Brokers. We're going to be hearing from Dr. Saverio Salandra of Thackeray Williams. And following that, we'll be opening up for a non-chat, but all hands up in the boxes, please. Question time, question and answer session, and I would like to first of all introduce President of South East London Chamber of Commerce, Helen McIntosh, to say a couple of words.
Thank you very much, Ed. Thank you. Yes, we're going to, just so everyone knows, we're disabling the chat, and at the end, if you could put your electronic hand up to ask a question, that would be lovely. Please keep your cameras on so we can see our audience. So I'm going to hand over now to Henry.
Well, thank you, Helen. Thank you for your introductions and for inviting me to speak today. So just a very brief introduction to myself and to Hornblower. Hornblower Business Brokers, we value and sell businesses in the SME and business, owner-managed business markets. We work with business owners that have businesses with turnover between 1 million and 15 million on the whole, and we have some focus sectors that we've done a lot of deals in. They include precision engineering and manufacturing, IT services, managed services and software, facilities management and commercial cleaning, as well as various other B2B service sectors. We have offices in London, Bristol, Nottingham and Dublin, but we service clients across the UK and internationally. We typically work with business owners that are looking to retire or have reached a point in their business which needs where it needs more resource or management to grow to that next level. So I want you to imagine for a moment that you've sold your business. It's probably about 3 to 6 months since you sold, and you've done most of the handing over. And perhaps you've finally retired after 10, 20, 30 years working in your business. And you've perhaps sold to a larger trade buyer who's taken on the day-to-day management and is rolling out your product or services to their larger client base, or indeed an investor or an individual who's taken over your business. And so now there's no more dealing with product, service deliveries, staff issues and managing staff, or even managing the finances. So how does that feel? Perhaps it's a good feeling, a bit of relief. Perhaps it's a little uncomfortable and you're wondering what to do next. But what we're going to talk about today is really, well, how do you get there? And is it possible in 2021? Do you sell is your business ready to sell now? Or do you hold on for another year or two while you put a few things in order to sell your business? First question really is about valuation. Ed, if you could put up the slide on the valuation, please. No, scroll up one. There we go. There we go. Oh, missed it. If you could scroll up again to the picture. No, sorry, down to the one with the picture. Right, thank you. That's great. There are various valuation techniques. They're normally based on a return on investment, as well as some of the balance sheet assets. And what I'm going to go through is really the most common means of coming up with a valuation is looking at what we call a multiple of EBITDA. So that's earnings before interest, tax, depreciation, and amortization. And there are a variety, there's always a range of multiples of this EBITDA that we put on various businesses. And where you sit on those, on that scale of multiple, will really depend on on the various aspects of your business, which will drive that valuation. So I'll go through those now. But in doing a valuation, there's what we call an enterprise valuation, which is based on the multiple of EBITDA. And then we look at separate items such as property, stock, or surplus cash, which is surplus to your normal working capital requirements, which we tend to look at independently to and in addition to the enterprise value. So the main aspects about your business are as follows, really. Your unique know-how in the marketplace. Do you have something that competitors don't? And do you have something that potential other investors or other businesses could not sort of produce quickly in a matter of months? If you do have that unique bit of know-how or even intellectual property in terms of patents, then that is a real barrier to entry, and that will drive up your multiple of EBITDA. Secondly, how do you generate your income? Is it generated on a project-by-project basis, where you have to go out and secure each new project, each new client? Or particularly if you're in a service sector, are you able to charge a recurring revenue? As an example, IT companies which offer managed services and email and and protection, etc., they often charge their clients on a monthly basis per user, which actually generates what we call recurring revenue and is seen as really sustainable revenue by buyers, and that's really where the value lies for a service business. So again, recurring revenue versus project by project income will really drive up that multiple and that valuation. Next one is your growth profile. Businesses that are growing year by year by a comfortable 10% or something in that order will be very attractive, because if you can show sustainable growth, then that shows that the market is you're in a sort of comfortable, sustainable market for your products or services, and that will give confidence to the buyer in the future of your company. Next one is reliance on you as the owner. This is quite often a challenge for owner-managed businesses. That's the business relationships with clients or with suppliers is often reliant on the owner himself or herself. So in preparing for sale, it's really important to prepare your management team or develop a management team, or identify one or two people in your business that could take over the day-to-day running of the business as you exit and hand over to the new buyer. Next one is, again, reliance on the top customer. We often see this with engineering businesses, that maybe their top customer represents 40–50% of the total annual revenue, as they have become quite reliant on that customer over the years, and that customer also reliant on them. But for a buyer coming in afresh to your business, that does represent a bit of a risk. So whilst it may or may not affect the multiple and the headline valuation, the buyers will start to look at the types of terms that they can put around their offer to mitigate some of the risk that one main client could go elsewhere. As a rule of thumb, we recommend that your top customer represents no more than 15% of your total revenue. So yeah, and then next is financial performance. Make sure that you've got a clear set of accounts that shows very clearly what your monthly P&L is. Yeah, I can't underline enough being able to produce your monthly accounts in a timely fashion for buyers, because they'll be wanting to look at that latest performance, not your year-end accounts from sort of 12 months ago. Okay, so moving on to who seeking the right advice and who you'll need in your exit team. So the three main players are really your accountants, and as I said just now, it's really important that you have your latest financial performance documented well. And so if you need sort of help to do that from your accountants, it's good to have them on board right from the start of the process. The management account systems such as Xero and QuickBooks, etc., actually enable you to do quite a lot of that yourself now. But if you're going to do that, make sure you're well acquainted with how to print off a P&L report at the end of the month, your balance sheet, and age debtors and creditors. And your accountant's also there to offer sort of tax advice. Everyone's individual circumstances are different, so it is worthwhile reviewing with your accountant what the implications of the sale will be for your tax situation. The next party will be your commercial lawyer, and obviously Sally can talk far more about this in more detail in a moment, but they are there to draw up contracts once the deal has been agreed in principle, and we found that you've got a buyer that you've got an agreeable deal with. And they tend to, so they'll be drawing up sort of sale and purchase agreements and consultancy agreements for any handover period or any involvement that you'll have in the business post sale. And the third party is your business broker or corporate finance advisor, or in some cases at the smaller end of the market, business transfer agents. We come under various different names. But we're there to really set expectations from the start in terms of the value of the business, defining your exit strategy, and the type of, as well as coming back to the value, as well as that value, what type of deal structures you can expect depending on the shape of your business and the various aspects of your business. Then we're there to find the right buyer, the right buyers, and qualify them, that they have a fundamental interest in your business and that they have the funds there to offer the type of deal that we're looking for. And then by getting a number of buyers to the party, then we can negotiate on your behalf the best deal overall. And we're there to really manage that whole process from preparing your sale memorandum to marketing, to finding the right buyers, to qualifying the buyers and negotiating the deal on your behalf through to completion. So just to finish off, just a quick run through of what to expect from the process. So once you decided to go ahead with the sale, the first thing that we'll do is to prepare a full information memorandum, which is a document, tends to be sort of 25, 30 pages, explaining to buyers all the information that they need to know about your business to be able to make a decision whether it fits with their criteria, and have a rough idea of the type of value and deal structure they would be likely to offer. Now, that document doesn't go to buyers until they've signed a non-disclosure agreement and also have your approval to release further information. We'll then launch the marketing to find the appropriate buyers. We'll send out the memorandums and answer initial questions once they've signed that NDA, of course. And there will come a point in the process where you have meetings with those buyers. Typically, it'll be half a dozen to a dozen different meetings with buyers that will be that your broker would line up for you, and it's then it's a matter of receiving the offers, negotiating the best deal, seeing which one works best with what your own objectives are, and dotting all the I's and T's and what's been agreed in what we call a heads of terms document. Once that's been agreed, that's when a buyer gets exclusivity on the deal, and they start their process of due diligence, which falls into three main categories of legal, financial, and commercial. And I know that Savvy is going to explain a bit more about the legal due diligence. The financial is about making sure that what's in your accounts is a true reflection of reality, and also looking at your commercial. The commercial side of things is looking the buyer looking in a bit more depth about into your client base and the contracts that you've got in place with them. Once that's done, lawyers will draw up contracts, and there will be a little bit of toing and froing until the deal is ready to complete. So that's just a very brief overview of the process, valuations, what valuations depend on, and hopefully will give you an idea of where in the process you are in terms of being ready to sell, and whether you're ready to sell this year, or whether you need to put a few things in place over the next year or two. So with that, I'll hand you back to Ed.
Well, thank you, Henry. I'll pass over to Helen, in fact.
Thank you very much. Yes, batting this one around. That was fascinating, Henry. Thank you so much. Well, we're going to hear Savvy speak. So we're going to get the lawyer's point of view. Over to you, Savvy.
Hi, Helen. Thank you very much for the introduction. So yes, I'm Savvy from Thackeray Williams. Just a quick brief about Thackeray Williams. We are a full-service law firm. We have offices in London, Bromley, Sevenoaks, and West Wickham. As a law firm, we offer service in will, tax and administration, family law, dispute resolution, employment law, residential property, real estate, commercial and residential, corporate banking and finance, and finally commercial. As head of department of Thackeray Williams in corporate and commercial, we usually deal with merger and acquisition, shareholder and partnership agreement, finance and growth funding, joint ventures, insolvency restructuring, and from a commercial side, with any kind of commercial contracts, intellectual property data protection, terms and conditions, franchise agreement, business startups. Now, as we were discussing before, and as you heard from Harry, today we are going to talk about the topic if it's a good time to sell now or wait for 2 years or not. Of course, there is not really an easy answer to that, but really it's going to depend from the situation of the company and the situation of the personal individual. So if we can start with the reason for selling your business, slide number 1. So basically, any reason to sell the business, if you are a seller, there are different kind of reasons, and of course, everyone is in a different kind of life set. So usually it's because maybe you are looking for new opportunities, maybe you are looking for growth, something that can be different from your business or in connection with your business. Maybe you are concerned, maybe you are concerned about some change in the industry. Maybe you have some personal circumstances that has changed, or maybe you want to retire. So you have loss of interest in what you're doing. So all these kind of reasons are different for any kind of seller. And of course, the path that are going to take can be completely different. If we go to slide number 2, is your business attractive to a buyer? But that's the most important things. I mean, usually when you are going to sell a business, you need to make it attractive to the potential buyer. Now we can have different potential buyers that are looking for different things in a business. An example, type of business of buyer can be like family. So you can have family members that want to buy your business, especially if it's a family company, Or you can have some kind of strategic buyers that maybe they want to expand their business in an horizontal or vertical way. Or maybe there can be some private equity company that are looking to add some company to their portfolio. Can be also because maybe you want to retire, and maybe your management want to take over of the business. So you're going to have what is called an MBO, or maybe individuals coming from outside, and then you have what is called an MBI. Usually what they are looking for in a business as a buyer, it's an ROI, return of investment. They want to see that there is like a kind of sustained growth in the business, and that you have some kind of different income from different customer base. That's because sometimes it can be a little bit dangerous to have or buy a business where actually, example, 90% of the business come or is generated only from one client. So basically, they're going to be really subject and liable to that kind of client. Usually, as we were saying, the business that buyer are looking to buy are business that they show a growing profit that is quite high. Maybe they are penetrating some new market, and maybe they have some new products. If we can go now on the third slide, we can talk about the deal structure. Now, deal structure. Usually, when you are buying a business, there are different kind of way to buy business, and mainly the two way are a share sale or an asset sale. So if you are buying, example, a business and you are doing a share sale, basically you are buying or the share in the business. So the buyer is going to purchase the share of the company and is going to acquire the complete company, including all its liabilities. That can be quite easier from a seller perspective, because basically you are going to sell directly, completely the company and not just the asset of the business. Can be also quite valuable for what concerns the continuity of the business. And the transaction can be a little bit more simple as to put in. And so we need to take in consideration that when you are going through that kind of structure, the share sale, probably the due diligence can be a little bit more invasive, because as we said, you're not just buying the asset of the company, but also the liability of the company. So from a buyer perspective, they really need to make sure that are what they are going to be liable for. An asset sale usually is when actually the buyer is going to buy specific assets in the company and sometimes specific liabilities. So example, they can be interested in the property of the business, or maybe they can be interested in some contract or all the contract of business, maybe in the goodwill, the name of the company, some IP or plant machinery. So this kind of business of structure maybe can be a little bit easier, or at least more specific from a buyer perspective. But of course, there is also some other kind of things that need to be taken in consideration, like TUPE in connection with the transfer of the employee, and any kind of property and tax. Another important things when you are selling your business, of course, one of the main important things, if we go to slide number 4, price is the price. Now, when you are having you are negotiating basically your asset or share purchase, of course, you need to focus also on the price. Now, the price can be paid in a different way, what we call a consideration. So it can be what is a cash consideration. So a cash consideration usually is immediate, and of course, it's a low risk for what concerns a seller point. Of course, also there are sometimes buyers that would like to have a deferred cash consideration. So it means that they can pay part of the consideration right now, and the second part maybe in 3 months, 1 year later on. Of course, this is going to add some kind of concern on from the seller point, because maybe the buyer can be liable, can be able to pay today the consideration, but we don't know if he's able to pay the consideration in 1 year from now or 6 months from now. So that probably is going to require a little bit more assistance and maybe some security to be put in place. Another way that the payment provision can be structured with is an earn-out. So basically, it's a kind of a portion of the purchase price is paid on completion, and portion is paid in the future based on future performance of the company. Example like profit, sales, EBITDA, and so on. It's a little bit more complex, and of course, put the seller in a different kind of situation. Other part of consideration that are part of the consideration during a transaction can be formed by loan notes. that usually it's a purchase price paid in installment to the seller, or maybe sometimes can be also some kind of exchange of shares. So basically you are paying as a consideration shares, maybe in the buyer company. Now, another important factor is not just selling your business the price, but is understanding if you're ready to sell your business. I mean, there are a lot of different things that need to be taken in consideration when you're selling your business, as Henry was pointed out. And it's basically commercial side of the due diligence, a financial side of the due diligence, and the legal side of the due diligence. Now, usually the commercial part is carried out by the buyer, and basically is trying to understand the business the best way possible. The financial due diligence is usually carried out by the accountant. So basically they're trying to determine if your accountant and the purchase price reflect exactly what is in the value of the business. And then there is a legal due diligence. The legal due diligence basically is done by the buyer solicitor in accordance with the seller solicitor, and they try to understand anything about the legal risk in the corporate structure, asset, contracts, IP. So usually what kind of due diligence the buyer is looking for? Usually what they are looking for is, example, taking any kind of inside information about corporate information. So the structure, article of association, shareholder agreement, resolution, detail of shareholder, director, and so on. They would like to see all the account, annual management and account, banking and finance information, some key contracts like supplier and customer, detail of some assets, example, property, the condition, the use, and so on. If there are any kind of intellectual property, that can be rights, license agreement, IT license, data protection, how is conducted the data protection, if there is any data privacy policy in place, and of course, any kind of insurance, if there is any kind of claims, if there was a litigation, if there is an outstanding litigation. These are the most important things that usually buyers would like to see through a due diligence. That's why it's very important to prepare yourself. So that's why it's very important to have all this kind of information in place. And maybe you need to be a step ahead before putting your business for sale. So try to have all this information in place. It's going to make a transaction to be go much more smoother than before. So usually that's why you have like a kind of a preparation. So trying to put everything in place. Then after that, you have pretty much all the document in place. Then you start what is called marketing of the business. And then after you find the buyer and you market your business, then is when you start the negotiation, due diligence, and completion. A lot of times, the first question from a seller or buyer is how long does it take to sell a business or buying a business? Well, that's, as we were discussing, depends from different kind of factors. So that depends how ready you were when you start the process of selling the company, how is going to be structured the company, how complex is going to be the share purchase or asset purchase agreement to be put in place. And of course, from the type of buyer that is going to buy the business. Another important thing that usually we discuss with the client, if we go to slide number 06, what will you do post the sales? And that is very, very important part of the business, because usually you are selling a business and you are going to find that you need to realize what does for you exactly owning a business means, and how you're going to replace that part of your life that was like the business. And are you ready perhaps to retire or maybe to start something new? And this basically is very important because it's going to be part of what is called a post-completion restriction that usually you find out whenever you have you are signing a share purchase agreement or an asset purchase agreement. So usually a buyer will want to prevent the seller from establishing or having any kind of a competition or be involved in a kind of competitive business. So there's going to be some kind of restriction on which kind of business you can do after you sell your company. And example, there are going to be restriction on poaching any kind of customer or employee of the company, and then restriction, probably other kind of restriction on geography. So if you can do some business, example, in 10 miles, or maybe you need to have 20 miles far away from the business that you sold. So basically you need to understand if you're ready to give up everything that basically you loved in the last 10, 20, or 30 years. How we can help. So as Henry was saying, basically it's very, very important to put all these pieces in the puzzle at the right time in the right place. So that's why usually before you start any kind of sale, you're going to talk with your advisor, financial advisor, accountant, and trying to make a process very smooth. So trying to understand exactly which kind of asset or share sale you would like to have, understand exactly what are going to be the tax implication for you and your business, and exactly which kind of structure you would like to put in place, and the price. So that's why it's important also the second step to contact the broker, as Harry was saying, and understand exactly what is the valuation of the company. That's sometimes not exactly based on the poor income of the company or revenue generated by the company, but there are a lot of different factors. Then the third part is instructing a lawyer. And then again, the lawyer is going to be in charge of discussing the first head of terms, understand what are going to be the term and conditions that are going to be structure the transaction, and will be also very important after you sell the company. Of course, you are going to be the owner of some kind of cash consideration. Understand exactly how you are going to deal with the post-sale proceeds. So what you are going to do with the fortune that you generate after you sell the company. Thank you very much, Ellen. And this is from us, from Thackeray Williams.
Thank you. Thank you very much. That was fascinating. I've got a couple of questions I'd like to ask, and I'm going to ask one of Savvy, and I'm quite intrigued about this. When should you both talked about heads of terms. When do you use heads of terms?
Well, usually, I mean, head of terms are a very, very important part of a sale, share sale or asset sale. Head of terms are not a substitute of a detailed contract and will not be binding from a legal perspective unless states so, example, a confidential clause or an exclusivity clause. Mm-hmm. Head of terms should always be subject to contract. And of course, if you're acting for the buyer, should be subject to due diligence by the buyer. Sometimes can be some, of course, it's going to, when you are going to draft some head of term, it may be that some cost is going to be incurred in agreeing the head of terms with other party. But this is a kind of exercise, in my personal opinion, that could pay its reward in the long run, as without a clear indication of the agreement, it will be an open playing field when you are going to start drafting the substantial clause of the purchase agreement. Yeah. Usually the head of terms will include, example, if there is a deposit that need to be paid, the purchase price, how it's going to be structured, the purchase price, the sales, if it's going to be asset sale or share sales. There are going to be some kind of confidential provision, K warranties and indemnities, maybe the buyer would like to find in the agreement and then maybe the seller is willing to give. Detail of any kind of premises, if it's a freehold or leasehold. Detail of equipments, intellectual property rights, and maybe a timetable. So basically, it's a good exercise to understand exactly where you are, which kind of clause or provision you're going to find in the agreement, and exactly example the purchase price and which date we think is going to be a completion date.
Thank you very much for that very clear explanation. Ed, do you have any questions?
I've got a question for Henry actually. And let me just read this to you. How has COVID and the lockdown, or lockdowns plural, affected business valuations? Have the multiples changed?
Well, no, thanks for that question. Yeah, it really depends what sector your business is in and how it has fared through the lockdowns. There are various types of businesses that have fared quite well during the lockdown. So the obvious example are the technology companies that have enabled people to work remotely from home. There are a number of other businesses that have quietly got on with business, not quite as usual, but they are continuing to get a good level of revenue and profit in. And so businesses in those sectors, I'd say the valuations have certainly held up. And the types of deal structures that have been held are in line with what they were previously, if not slightly enhanced, because that they've proven their sustainability through quite tough times. There are other businesses that obviously have been affected by the lockdowns, but actually are able, have seen, particularly maybe they were affected in lockdown one, businesses such as construction, where they had to close down, but actually in the second and third lockdowns they haven't been stopped from trading as much, and actually they've seen quite a good rebound. So again, those businesses are being really valued on at the normal sorts of levels. There are sometimes some terms in the business to protect buyers from perhaps, you know, things that might be coming up ahead in the economy. But generally, if it's in a business sector that's doing reasonably well, then valuations are holding up. I'd say that really it's the sectors such as events, hospitality, travel, which are obviously have been affected by COVID, and again, they will be expected to come back, and I think valuations will come back. But I think we're still at a point in time where it's impossible really to hang a valuation on a business, because we don't know how it's going to come back and when. I know restrictions are lifting now, but I think it will be a few months now till the autumn time till we're really able to establish how those businesses are coming back. But I think that the main point is that many people might think that this might be a buyer's market. Well, actually, there are quite a few buyers out there, all looking there is quite a bit of private equity money, investor money out there looking for businesses to invest in, and actually what we're seeing is it's actually as much of a seller's market for the right businesses.
Right, yeah, so there's more people buying than you might think.
Yeah, that's right.
Yeah.
And therefore valuations are holding up.
Are buoyant, yeah. Okay.
Can I ask one more of Savvy, please?
Sure.
My question is, you know, what do I look out for in a share purchase and an asset purchase agreement? What are the keys?
Well, as a lawyer, I would suggest to look for any kind of word in the agreement. Even a word can change something, and every clause is very, very important in agreement. But and usually they are really quite extensive documents. So an asset purchase agreement or a share purchase agreement can go from 20, 30 to 150 pages. And of course, it's very important to have an understanding of what exactly you are promising or you're selling. Of course, there is a different kind of prospect from a buyer and the seller. Now, the most important things will be probably, as we discussed it before, will be the price, the purchase price. So how is going to be paid? It's going to be a deferred consideration. It's going to be an exchange of share. It's going to be paid in cash at the end of the transaction. It's going to be any kind of mechanism. Example, the seller usually trying to have what is called a locked box mechanism. So basically, it's where you have like a fixed price that was already agreed with the buyer, and that is going to allow what we call certain leakages during the negotiation, where actually maybe from a buyer perspective, they are looking to have a kind of a completion mechanism that is going to give them some kind of flexibility, and is going to create some kind of flexibility also in the valuation of the price. Another important things are the warranties and indemnities. I mean, warranties and indemnities, usually if there is a breach of warranties as a seller, is what can give to rise to a successful claim in damages by the buyer. And of course, if you are giving a warranty, it's going to be treated in a different way than if you are giving an indemnities or a representation. Based on that, of course, the buyer will try usually seek to include some further and specific warranties in the agreement. Example, the capability of the IT system, or if there was any kind of example now, right now, government scheme in place, size of the workforce, and so on. From a seller perspective, usually, of course, you need to understand that the buyer is looking for some further warranties, but usually you are likely to resist to accept any kind of warranties that are forward-looking. That maybe you are going to be some kind of out of the targets of your target's control, so you cannot really control them. So these are probably the most important things to look in a share purchase agreement or an asset purchase agreement.
Yeah.
Sorry, thank you very much, Savi. Ed,
Now I've got
your
another one.
question?
Yeah, I've got another one for Henry here. So asking, I am looking to retire, but my slightly younger business partner wishes to continue for some years to come. Is it possible to sell my 50%?
Yes, certainly. Deals do get done in that way. It will rely on the buyer and your other director coming to an agreement to work together. But no, certainly deals like that do happen. I think from a buyer's perspective, it's actually quite an advantage sometimes that one director stays on, because that gives sustainability of that sort of reliance on the owners, because one is staying on. We did a deal a bit like this a little while ago, where it was an engineering business. There were two shareholder directors. One was retirement age and one was 10 years younger. And so the younger one was willing to go on and drive the business further, but obviously the older one wanted to take his retirement. So what we tend to do is it's a good opportunity, obviously for buyers to get a director on board that knows the business, but also for that remaining director to maybe take some cash off the table. So in this example, we sold actually 70% of the business to the buyer. The outgoing director took 50% of the notional, 100% of the valuation, and the remaining director was paid out 30% and so 20%, sorry, and retained 30% of the company. And then he and the buyer worked together from ongoing now, and sort of taking the business forward.
That's right. You're buying the experience and built-in stability, or what's the word? Sustainability you used. Yeah.
Yes. Yeah.
Oh, okay, thanks.
Well, I'd like to thank everyone. This has been a really fascinating session, and maybe we could do this again in the future. So I'd just like to thank everyone, and bye-bye.
Well, thanks very much.
Thank you very much.
Okay.
Bye.
Thank you.
I wish you a good day.
Okay.
Bye.